Okay, we're about ready to explain selling short, or what's called a short sale. Before I do that, since this is going to be the last time I'll be at this point, mainly just for interest, I would have offered you in a face-to-face class three options: sell now, hang on, or buy more. Some people bought more. This is actually a technique called averaging down, and it's not particularly germane to what's happening in 1929, but let's be clear on it. Let's use our fictitious corporation, ABC Petroleum, and we're going to keep the numbers simple. Okay, you bought 1,000 shares of ABC at, say, 20 bucks a share. It wouldn't have been anywhere near that high back then, but just keeping the math simple. Okay, ABC hits on rough times, and that the price has dropped to 10 bucks a share. So the value of your investment has dropped by half. Now, there's a funny thing about the math here. To recover a 50% drop, it takes a 100% gain. Okay? It went down from 20 bucks a share to 10 bucks a share. That's a 50% drop. 10 to 20 is a 100% gain. So, let's say you went out and bought 1,000 more shares at 10 bucks a share. You've averaged down. Your average investment per share has dropped from 20 bucks a share to 15 bucks a share. So it doesn't have to go back up as far to get you back in the clear. All right, selling short. How does selling short work? As I say, it's a technique whereby, again, it's not guaranteed at all most of the time, where you can profit from a decline, a fall in the price of a stock. Okay, let's just run a scenario here. Let's say you've been watching ABC Petroleum stock pretty closely, and you think it's riding for a fall. You think, for whatever reason, that stock is going to go down in the next few days. So you call up your shady broker and tell him you want to sell, pick a number, 10,000 shares of ABC short. Now, they don't have to execute that, but let's say they agree to do it. Now, here's the funny part. You do not have to own any ABC to do this. In fact, even if you do, the stock that you own is not going to be part of the deal, because the stock you're selling is actually rented from the brokerage. They sell 10,000 shares of ABC from their own portfolio and charge you a fee for doing this and credit your account with the money that comes in at today's price. So far, so good? Okay. Now, within the next 3 business days, that brokerage is going to go back into the market and purchase that many shares of ABC at whatever the price is then. Okay? And charge you for that, plus the fee for doing the transaction. Now, if the price has fallen, then you get to pocket the difference. Okay? Got it? You sell at the higher price. You borrow something, sell it at today's price, and then buy other stock to replace it at the later price. And if the later price is lower, you come out ahead. Now, if the price stayed the same, it's a wash, except you still have to pay the brokerage fees. If it went up, then you got to come up with the difference. It's a legal form of gambling. Is not regarded highly by reputable brokers, if I'm correctly informed. Now, what's happening in the September and especially into October is, massive short sales. If you're ever tempted to play the stock market, and I've been tempted, but I've never done it, you got to understand, you're walking out on the field there with professionals. You are a minnow in a shark tank, because in, say, October 1929, you had pension fund managers, you had insurance companies, you had enormous short sales going down, and they are sure bets. So they're dropping, say, tens of thousands of shares of certain companies short, knowing for a fact that just the sale of those guarantees that the price will go down. Okay, and they're reaping huge harvests here in the short run. Now, if you happen to be a small investor in that company, they are making the price go down. You're trampled underfoot like an insect, especially if you bought on margin. So this ends up being very destructive. Short sales. All right. So as the month of October goes by, things are getting more and more serious. About the last third of that month, the market would just go into, by the market, I mean the trading floor of the New York Stock Exchange. It just goes into free fall. And uh, twice, maybe conceivably three times, the big investment banks on Wall Street would get together, uh, pool a big bunch of money, and send their representatives on the trading floor and just buy all they could buy, just to stabilize it, just to provide a floor. Now, what would be done in more recent times is that bell would go clang, 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 and they just shut it down. They just shut the market down earlier in the day. They didn't know to do that then. So, and then the next day it's back in free fall. So there's 2 or 3 days, black this, black that. But the one that finished it off for, well, it didn't really finish it off because it does recover eventually. It's called Black Tuesday, October 29th, 1929. The market's in free fall. The big investment banks have they're out of bullets. They've used all they had earlier and it hadn't worked. And there's pandemonium, there's fist fights, there's stocks for sale, and literally no buyers. They already had these electric machines called ticker tape machines. Sits on a stand, got a glass case of machine in there, and a thin strip of paper goes through and gets typed on, and you're looking through it, looking for what you've got. It's supposed to be an up-to-the-minute record of transactions on the stock exchange, up to the minute. By the time the day is over, it's behind by 3 hours. By the way, you go to a store, the merchant sets the price. You either pay it or you don't. In the stock market, it's an auction. The price is what is agreed upon by the buyer and the seller. Some people are out there trying to sell stocks. Some people are out there wanting to buy stocks. October 1929, there's virtually nobody out there wanting to buy stocks. Incidentally, old John D. Rockefeller, he got away clean as a whistle. He sold out, liquidated everything before this broke. He said, and although he was a sternly moralistic man who taught a Sunday school class, he was a Northern Baptist. He claimed that he sold out on the advice of a shoeshine boy. Okay, I guess I better. So we don't know if that's true or not. And then later, of course, he buys all the stock he sold back again at a fraction of the price. Maybe that's why he becomes part of how he becomes the wealthiest American all time. So the market caves in, and it did not stop that day. By the way, there was a entertainment industry publication called Variety. It's a newspaper. It's all about plays on um, Broadway, opening and closing in movies and all that, and using some entertainment industry slang. They ran the headline, "Wall Street lays an egg." A play that opens and bombs and closes soon has laid an egg. Wall Street lays an egg. It's a crash. Okay. This does not cause the Depression. This is, I guess you might call it the starting gun of the Depression, because it didn't just happen in a day. I'll get back to that. But it cancels out the kind of consumer confidence that is necessary for the industrial sector to continue to sell cars and washing machines and radios and stuff like that. The thing people have to sign some papers and agree to pay it out by the month, because increasingly there's this pessimism about this collapse, because the stock market, the economy was already in trouble, as we're going to see. Nobody heeded that because the stock market was strong. And that was mistaken for an indicator that the economy as a whole was strong when it wasn't. Okay. Stocks continued to drop precipitously for the next two weeks. It hit its low point for the year 1929 on November 13th, when it closed at, I think, 224. It's dropped from 452 to 224 by more than 50% from Labor Day to November 13th. Then it rallies a bit, something known on Wall Street as a dead cat bounce, as profit takers move in to buy up stocks when they're cheap. I had a student tried to argue with me one. Dead cats don't bounce. I think I think he didn't quite get it, and that's what it's called. Uh, so from the high for the year to the year end, it's down about 40%. But think about that. 40% of all the money that had been invested in securities on the stock exchange is gone. Okay? The slide continues through the entire year 1930, the entire year 1931, and it bottomed out for the entire Depression on July 8th, 1932, just after the middle of the year. It hit the bottom, the lowest it got, began a slow recovery after that. But the market had fallen from 452, a figure that would not be approached again until the mid 1950s, to 58. Okay, no wonder 1932 is the bottom end of this thing. Okay, now some economists, and the way they really technically look at this, it's not where the market is, it's which direction it's going. Okay, if it's not going down anymore and it started going up again, even though that's drastically lower than where it was before, some would say, well, that's the end of the Depression. And it's a slow, rather jagged comeback after that, with a secondary collapse in the year 1937. By 1936, almost back where it was before the crash. And then, for reasons I explain in the supplements, slides back down the hill again. Okay. So there's your stock market crash. If the economy had been strong, this might not have happened at all. Or if it had, it would have been contained pretty easily. It might surprise you to learn that the 1929 stock market crash, at least the Black Tuesday itself, is not the biggest percentage one-day drop in the history of the stock market. That was, if I'm correctly informed, October 19th, 1987, at a time when the economy was basically strong, and it was kind of a software thing that panicked a bunch of people. But the economy is already weak in three major areas. And you say, well, what else is there? Agriculture, manufacturing, and banking were all at what economists call disequilibrium. And I have a more technical explanation of this in the supplements. It's easy to understand, I believe you'll find. That gets into some economics review that you were supposed to have learned in economics in high school, and I hope you did. I don't know how many other history classes where you get this, but the specific disequilibrium is surplus, excess quantity supplied. Okay, this happens when price is above equilibrium, equilibrium being the price where supply and demand, or quantity supplied and quantity demanded, are in balance. Everybody that once got one at that price, there's no unsold merchandise left on the store shelves. Okay, so what you have is chronic oversupply. There's too many farmers producing too many farm goods, so that as the price drops toward equilibrium, as it normally would, it drops below the minimum level required to keep all the farmers profitable enough to keep farming. Manufacturing, price drops in an oversupplied manufactured goods market. Not all those manufacturing concerns are going to be able to continue. And these are in the order in which they hit. Okay. Banking. The banking crisis is not till about 1931 or 32, but there's more bank credit available than can be absorbed. Again, price dropping below what the economists call equilibrium means that a bunch of these banks are not going to make it, and their depositors are going to suffer when they go under.